the data in the U.S. look remarkable. I mean, I was even surprised how strong the ISM was, especially the forward-looking components like orders, which suggests to me that the tax cut from last year is actually working to galvanize capital spending. All that's very good. The problem, Brian, is if you look at the dollar, specifically the dollar within the emerging market side, the EMFX as it's known, that has seen tremendous appreciation. And the problem we have, Brian, is that the better the U.S. data look, and yesterday's data are a case in point, the more likely it is the Fed continues to hike. And as I've argued many, many times, the amount of hikes that the Fed is telling us it plans to do greatly exceeds what is priced into the market. So that will provide, Brian, a very solid underpinning to the U.S. dollar, especially versus emerging markets. And therefore, it will keep pressure on these various currencies and obviously markets, and that's what we're seeing.
Economies, though, are slow-moving objects. We haven't seen an impact yet, Joe, but do you think that we will?
Perhaps. I mean, the one interesting thing about yesterday's ISM data, we did see some weakness in the export components in both yesterday's data and some of the regional series, as well as some of the foreign PMI. So there is some residual concern about trade. But again, coming back to what the Fed is doing and looking at U.S. fixed income markets, the yield curve is very flat. And I will continue to argue that as long as the Fed is on this this path of higher rates, more so than what is being discounted in futures, financial conditions could tighten and we do have risks. And if the Fed wants to slow the U.S. economy, keep tightening because the channel by which the U.S. will eventually slow could come via EM.
I guess that we've been so accustomed to these big swings in economies because we've had two major recessions over the last 10 or 12 years that we just can't accept, or maybe it's just some people cannot accept, that things can remain good for a long period of time. Do you think there's an implied negative bias? Only because we have been punched in the face economically pretty hard twice over the last 15 or so years.
You're exactly right.
Don't worry, that dog won't bite. He's bit twice, but I promise it won't be a third time.
Yeah, but you forgot the corollary to that. That's not my dog, if that was the Peter Sellers line. But if you look at the U.S. in absolute returns, the S&P is up about 8%. World equity markets, ex the U.S., are down about 5%. So the U.S. has remained relatively immune, and I think that will remain the case, where we continue to perform reasonably well compared to everyone else. But again, when you talk about the economies and slow-moving activity, the U.S. economy is probably going to hit 3% plus growth this year. That hasn't happened in a long time, where the rest of the world has seen slower activity. So markets are reflective of that. But of course, they always overreact, and you get more volatility than, as you pointed out correctly, slow-moving trends in data.